Good afternoon, everyone, and welcome to the launch of Sri Lanka State of the Economy 2021, the annual flagship publication, the Institute of Policy Studies of Sri Lanka. This year's report focuses on the theme of pandemics and policy, protecting health and promoting economic recovery. Traditionally, the official launch of this report is a physical event. Unfortunately, due to the pandemic, last year for the first time, we had to launch the report virtually. This year too, the event takes place digitally. However, one of the benefits of this is that we have participants from all over the world joining us today during this live discussion. We welcome all of you. The theme of today's webinar is COVID-19 and the Sri Lankan economy, policy choices and trade-offs. The main issues that we will discuss are Sri Lanka's macroeconomic outlook, trade and competitiveness. This webinar is the first of 3 that IPS has organized on the State of the Economy report. The second webinar will be held on October 13th and the third on October 14th. You can visit our website www.ips.lk for further details. There is a short video which sets the background to today's discussion, and we would like to share it with you now.
As the world struggles through a second year of COVID-19, there is positive news in a better than anticipated global economic rebound. By 2022, world economic output is expected to reach pre-pandemic levels. The recovery, however, will be uneven, with wealthier countries performing better on average than developing countries. They have been able to pump more money into stimulus efforts and were able to secure the bulk of available vaccines early on. By contrast, low and middle-income countries were disproportionately impacted through a collapse in export demand, tourism and capital flows. As in the case of many developing countries, in Sri Lanka too, repeated waves of COVID-19 are taking a toll on the economy. But the economic contraction in 2020 can be followed by a V-shaped recovery in 2021. The challenge is to convert this recovery to sustained high growth in the medium term. The single biggest threat is the high debt load that Sri Lanka carries. A shift from concessional borrowing towards international financial markets and non-Paris Club creditors have deepened the risks from debt accumulation. As the pandemic drags on, pressures on government spending and borrowing keep mounting. For instance, micro, small and medium-scale enterprises have been the hardest hit. Despite supportive policy measures like the Saubhagya COVID-19 Renaissance Facility, only 11% of total loans were disbursed by end 2020. With a recovery in tourism set to drag on, more such MSMEs will continue to require government assistance. Encouragingly though, Sri Lanka's trade rebound is positive, mirroring a swift pickup in global trade flows. The recovery should not be derailed through attempts to curtail imports and narrow current account deficits beyond the immediate short term. Such policies impede export competitiveness and invite retaliatory action from key trade partners. It will also discourage productivity-enhancing foreign direct investment into the country. These need to go beyond infrastructure and mix development projects to high-value export sectors in goods and services. High volumes of foreign currency inflows from exports and FDI are critical to build up Sri Lanka's depleted official reserves and stabilize the rupee. Anchoring confidence in Sri Lanka's medium-term macroeconomic fundamentals within an appropriate policy setting will be vital as the country prepares to ride out the health crisis and support an economic recovery. For detailed insights, read IPS's Sri Lanka State of the Economy 2021 report. Focused on the theme of pandemics and policy, protecting health and promoting economic recovery, the report examines some of the key socio-economic issues and policy choices facing Sri Lanka today.
Before we move on, I would like to remind you that this webinar is scheduled to last 1 hour. It is being live streamed on our Facebook page and YouTube channel as well. A recording will be made available on our YouTube channel once the event concludes. You can follow IPS on Twitter at Talk Economics SL and use #SOE 2021 for live updates. You can send your questions to the panelists via the Q&A box, and we will try to accommodate as many questions as possible. This webinar will consist of 2 presentations and a commentary. After that, we will move to the question and answer session. Today, we have an eminent panel to discuss the state of the Sri Lanka's economy. I warmly welcome our panelists, Dr. Dushni Weerakoon, Executive Director of IPS, Dr. Asanka Wijesinghe, Research Economist, IPS, and Dr. Missaka Warusawitharana from the Johns Hopkins University in the United States. We are particularly grateful to Dr. Missaka for graciously accepting our invitation and joining us despite the very early hour in the United States. COVID-19 and the Sri Lankan economy, policy choices and trade-offs. When focusing our attention to this theme, it is vital to have a brief understanding of the prevailing macroeconomic outlook of the Sri Lankan economy. Dr. Dushni Weerakoon makes the first presentation of today's webinar on this topic. Over to you, Dr. Dushni.
Thank you, Tharindu. I'm going to go straight into the presentation on the macroeconomic policy outlook. In the state of the economy last year, we maintained that Sri Lanka will see a V-shaped recovery. Just going to get, I'm not able to get my screen moving, just give me. What we maintained last year was that Sri Lanka would see a V-shaped recovery, and that seems pretty much on the cards. Even if we assume a 4% growth this year, that will take the economy back to the pre-pandemic output level, thanks in part to the relatively weak output growth that we saw in the years leading up to the pandemic. Now, the critical challenge is to lift that growth rate to 5 to 6% and maintain that in the medium term. And the critical factor there will be, in that is how investment will perform. The drag on investment was the major driver of the output contraction of the economy in 2020. So Sri Lanka's story is pretty much what we are seeing in many parts of the world, with countries seeing a better than anticipated rebound. And that's again in large measure owing to the fiscal and monetary stimulus measures that were rolled out. Sri Lanka had little fiscal space and relied mostly on monetary policy. As you can see from the graph, a surge in direct financing of fiscal spending by the central bank and efforts to ensure that the borrowing costs were kept low through yield-controlled measures to put a lid on interest rates. Now, few would argue that these stimulus measures were mistaken given the scale of the crisis initially, but concerns do arise when such temporary measures are seen to take on a more permanent mode of policy engagement. Large-scale debt monetization programs have macroeconomic risks. These are more manageable for advanced economies. For instance, they have convertible currencies, they have historical low interest rates. The risks are also more manageable for those emerging market economies that have low levels of debt, limited exposure to foreign debt, and have high reserve stockpiles. Sri Lanka is not so fortunately placed. We have high debt levels, elevated exposure to foreign debt, and foreign debt repayments of sizable amounts in the medium term. And added to that is that we have very low reserves in hand. So with those kinds of weak fundamentals, the backbone of a debt monetization program is policy credibility, that is fiscal prudence and some assurance that the central bank will not fund fiscal spending indefinitely. Now, if you look back at Sri Lanka's fiscal policy path over the last 18 months or so, it is a little difficult to detect any notable effort to curtail spending, particularly discretionary spending. For instance, if you look at public sector employment, that jumped by 4.2% last year. The public sector salaries and wage bill expanded by a high 16% in 2020. And this is a year in which Sri Lanka's revenue to debt ratio is at its lowest in our post-independence history. And 72% of revenue collection went towards interest payments on debt. So this is in some sense a pointer to why we are so reluctant to deal with the IMF. This kind of flexibility would not be available under IMF programs. If you look at some of the ongoing negotiations that the IMF is having with countries that have approached it for assistance, freeze on wage bills, freeze on recruitment to the public sector, etc., are high on the agenda alongside efforts to raise revenues through revisions to VAT regimes, etc. So when fiscal plans are not anchored, large-scale debt monetization will generate the expected macro consequences. And for Sri Lanka, first off, that's on the currency side. Depreciation pressure on the rupee, but that graph is not truly illustrative of what's happening given the ceiling that's been imposed on the exchange rate at 200 rupees to the dollar. So beyond that immediate threat on the currency side is the potential for inflationary pressures to build up as that huge injection of liquidity works its way through the economy. Now, these are manifestations of the fundamental imbalances that the Sri Lankan economy has as its expenditures exceed income consistently over time. And in order to address these imbalances, policy measures need to bring through cuts in national spending or try and raise national income. Now, the latter takes a bit of time, and governments therefore tend to focus on the more immediate adjustment process of bringing spending or consumption cuts via government, firms, households, etc. And the typical policy mix would include tighter budgets, allowing interest rates to move with market fundamentals, and in our case, that would suggest interest rates to go up, and implementing a more flexible exchange rate regime, again, suggesting that there will be a depreciation of the currency. The downside is that growth suffers in the short term and debt ratios will worsen, not only because of the slower growth, but also owing to the exchange rate impacts on the outstanding foreign debt stock that we hold. So these are clearly politically difficult choices, especially when economic conditions are tight as they are now, and governments will try to avoid harsh austerity measures that may have unintended consequences of generating social unrest, etc. So various mix of policy options are being discussed and in some instances being used. One is to try and raise national income or raise growth, but there will also be immediate expenditure implications of that. For instance, to push public investment up will require that we resort to more borrowing, for instance, again, with risks of stoking inflation and adding to currency pressures. That calls for another round of adjustments that will involve spending cuts, etc. Alternatively, you can hold on to an overvalued currency and import curbs, capital controls, etc. But these have distortionary impacts on the economy over time. One other option that's been highlighted recently is that, instead of focusing on the fiscal side, we should concentrate on the export side and try and raise export earnings. Of course, an export push should be part and parcel of our growth strategy, but as a short-term measure to raise export earnings substantively requires that there is a resource switch to the production of tradable goods, and that once again requires a real depreciation of the currency, and that by association is once again related to bringing some expenditure cuts to address inflation differentials between Sri Lanka and its trading partners. An easier option is import suppression to try and hold on to as much foreign exchange as we can, and that's the strategy that we have followed in the past few months. But import suppression, again, is one means of bringing about consumption cuts through the non-availability of goods and services, or simply pricing consumers out of the market. And it has the downside of not generating foreign exchange that we need so crucially. So to complement import suppression is the idea that we can also then have a push to bring in more FDI, not only to bridge the savings investment gap, but also to provide the foreign exchange that we need. But there are questions. I mean, if you have a policy environment of import suppression, will we get the necessary volumes of FDI, and will we get the hard currency in hand as and when needed? As we know, FDI, the determinants of whether or not FDI comes in sometimes is well beyond the control of national government. So there will be this cloud of uncertainty on Sri Lanka's debt sustainability. Even with that strategy, that will be a drag on investor confidence. So there really is one means of balancing out all these risks, and that is for Sri Lanka to firm up its access to foreign capital markets. Ready access is crucial to roll over debt, to build up our reserves, and to manage the exchange rate pressures. And in order to defend our sovereign ratings and bring down the bond yields that we are seeing, fiscal adjustment once again is the necessary starting point. Now, the important question, and this is my last slide, any government will ask itself, is how tight a budget would be politically possible. And I'm sure that is the preoccupation of the government, as well as they prepare to present Sri Lanka's 2022 budget next month. And whatever the tax and spending measures are being proposed, equity concerns have to be at the front and center of any fiscal adjustment, given that it is the poor that have been disproportionately impacted by the pandemic. And this is a issue that my colleagues will come back to in the second and third webinars when we look at the socio-economic impacts of the pandemic fallout. Now, two things on the fiscal side. First is to commit to strengthen revenue mobilization. The argument that we should hold on to the current tax regime because any changes will generate uncertainty and lead to underinvestment. It pretty much holds true when you have a high debt overhang to begin with, because the private sector will factor that in as a potential reason for tax increases in the future. And secondly, to reduce leakages and improve the efficiency of existing expenditures, particularly on the discretionary, non-discretionary spending options that the government has. If we come to some adjustment on the fiscal front and improve access to capital markets on the back of that, then I think that will free up the space for a more orderly macro adjustment. Initially, there is bound to be more volatility. The exchange rate, for instance, may overshoot owing to speculative behavior, etc. But that can be stabilized over time. And it will also allow the central bank to reverse its debt monetization and focus on price stability, as that will be an area of concern in the coming months. And together, that a policy framework along those lines will provide a more robust environment to support investment and sustain Sri Lanka's growth recovery. So I'll stop at that, and Asanka will pick up.
Thank you, Dr. Dushni. With the COVID-19 pandemic, many countries, including Sri Lanka, started practicing mobility restrictions. As a result of that, there were significant changes in the global trade flows as well. In this context, some argued that world economies are going towards deglobalization. The second presentation of today's webinar by Dr. Asanka Wijesinghe focuses on the emerging global order, opportunities and costs for Sri Lanka. Over to you, Dr. Asanka.
Thank you very much, Tharindu. I am going to share my screen. Good afternoon, everybody. I'm Asanka. Give me a minute. I'm Asanka Wijesinghe, a research economist at the IPS. My presentation is on the emerging global order, opportunities and costs for Sri Lanka. With the 2016 presidential election in the US, people started to talk about the rise of protectionism, and there is a deglobalization. However, in 2020, Trump's protectionist tariff did not help him to win the re-election, and protectionism failed politically and economically in the US. However, with the pandemic, politicians and even some economists are talking about this reshoring, whether decoupling from global value chains will be beneficial for the countries. And Trump started China-US trade war. Now it is ongoing actually, because the tariffs are not reversed yet. And there is this China-US ideological battle actually between the market capitalism and the state-led capitalism. So the key questions we need to ask are, is there a deglobalization, and what are the challenges for Sri Lanka, and what are the opportunities for Sri Lanka? I won't talk about these two graphs actually. I want to ask this question: if there are deglobalization, whether data shows such thing? Actually, globalization is a broader topic, but looking at this trade aspect, trade to GDP ratio, we can see that between 1986 to 2008, we call this as the golden era of globalization. There was a hyper globalization, a high growth of the GDP, trade to GDP ratio in the world. But it was halted to some extent with the global financial crisis. But back around 2010, the ratio reverted back to the long-term trend. However, now we are seeing some kind of stabilization. It is like this growth is at a steady state. Actually, it is not kind of a shock. It is something we can expect because of after the hyperglobalization period, we should expect the growth reach steady state of growth. However, you can see the right-hand side graph, Sri Lanka's openness is continuously going down, especially after 2005. I think this is because of our GDP growth through non-tradable sectors. However, in our region, countries like Bangladesh, India, and overall South Asia, they are showing an increased trend of the openness. Then let's see what happened in the pandemic. Actually, you can see around 2008 September, there was this deep plunge that was due to the global financial crisis. Industrial production and also trade collapsed in that period, and it took some time to recover, but it recovered and it grew from that point onwards until we saw this another deep plunge in 2019 due to COVID. The stories, even after that collapse, industrial production and both trade recovered at the beginning of 2021. So the conclusion is actually there is a globalization, like the economists and economists like Paul Landras said. We don't see much evidence for deglobalization, but there is a slowdown of the globalization process. What is the world trade outlook? Actually, the WTO predictions were pretty much gloomy, and they initially predicted that trade will collapse between minus 13 to 30 sometimes. But 2020 contraction was just negative 5.3%. And in this October, WTO revised the March forecasts, and it is much optimistic. For 2021, they revised forecast, raising it up to 10.8 from 8 in March. And the 2022 trade growth will be about 4.7 versus their 4 prediction in March. So we have a good global outlook for trade. And we actually, this data from this modern data set, the signals emitted by the vessels in the sea. These are nowcast data using this IMF database. We found that actually the trade recovered. You can see this this uptick is around January 2021. It is total trade. Even the globally, the industries like vehicle industries, which are integrated through global value chains, they recovered faster by the beginning of this year. Okay, in this US and China trade strategies are concerned, the US strategies is the main thing is Trump tariffs are not reversed by the Biden administration. I think they are doing some homework. They are trying to weigh the political cost of such tariff removal, because Trump targeted the manufacturing areas like Michigan, Ohio, Pennsylvania, Wisconsin. In 2016 election, I think the Democrats are worried if these tariffs are removed, there will be a backlash for them. But their major strategy is supply chain realignment. They are trying to realign their supply chain for critical raw materials like semiconductor manufacturing, advanced packaging, these are Chapter 85 products, and large capacity batteries, and critical minerals and materials like lithium, cobalt. There are strategies to take these products away from China and realign the supply chain to the allies like EU and the Quad, like the Australia, Japan, India. So this is US strategies. And the China's strategies are deepening ties within Asia and beyond. Actually, they are taking partnership in regional comprehensive economic partnership. They applied about a week ago for CPTPP. We call this as Progressive Agreement for Trans-Pacific Partnership. Initially, this was TPP. Obama administration negotiated this, but Trump pulled out US from TPP. And they also completed EU-China Comprehensive Agreement on Investment. So these are the strategies of these two major economic powers in the world. So let's discuss what are the opportunities Sri Lanka has. One thing is China-US trade war is still ongoing, and there are tariffs on China's textiles imposed by the Biden administration. So we can, if you analyze using partial equilibrium models, we can expect that investment and trade diversion to Sri Lanka. However, gains are not yet materialized. There is this chapter by Wijesinghe and Wijesinghe. It is not me that actually, Anushka, it's a book chapter. They found that the gains are yet to be materialized. My thinking is that it will take time for the US retailers to realign their supply sources. And China is deepening trade integration. I think there is a chance for Sri Lanka for increasing value chain participation with China. It's a huge production economy. And another key opportunity for Sri Lanka is increasing semiconductor exports. This sign is just Chapter 85, electronics and equipment. You can see that this square, the line, there is this break. This break was around 2010 when lost GSP. That's the exports to the EU, because US is trying to realign supply chains to EU. I think it is critical for us to safeguard the EU market and work on increasing our exports on these HS Chapter 85 products to the EU. There are challenges, actually policy challenges for Sri Lanka. One thing is we are seeing increased quantitative restriction on imports. Initially at April 2020, we saw that government was a bit selective. The government was targeting consumption goods, but when the choice set contracted, the government moved towards intermediate goods like fertilizer and agrochemical. Right now, about 31.7 of imports by 2000 value are under import controls, whether they could be bans, temporary suspensions, import control license, credit basis requirement. The costs are actually, these are costly if we try to domestically substitute them, it is very costly. The final outcome is that USD inflow growth is less than USD outflow growth because domestic substitution needs foreign raw materials. The other costs are resource misallocation, potential retaliation from trade partners, and reduced competitiveness. We can see that in this data set that the global value chain participation between 2000 and 2019 between some countries, you can see Sri Lanka's participation declined, but Bangladesh, India, Pakistan, our regional competitors, they are increasing it. And Vietnam has a huge jump from 0.25 to 0.4. This scale is between 0 to 1. Another challenge Sri Lanka is facing is GSP plus. Our estimates show that if we lose GSP plus, if there will be a potential withdrawal, the impact will be about 627 million. The worst hit sectors will be textiles, but their utilization ratio is pretty much about 52%, so they will be a bit resilient. But the recovering seafood industry will be highly affected because it is already using nearly 100% of the GSP plus. So this is a challenge Sri Lanka facing. So our recommendations are step away from anti-trade bias. You can see that you could see that our trade openness was actually going down. One thing is one critical thing at this moment is securing GSP plus. We need to capitalize US supply chain realignment. As I mentioned earlier, it is HS chapter 85. And we need to increase utilization ratios in selected sectors like textiles. The factor that hinders this is actually the ROs, rules of origins. We can negotiate their accumulation rule. We can ask you to broaden this set of countries we can import raw materials from. And ultimately negotiate free trade agreement with the EU, because one day we will lose the GSP plus. And another recommendation is value addition to integration to global value chains. And we have found that actually the existing regional trade agreement have not that much beneficial for the country. They have not significantly increased our trade. So we have to restructure existing regional trade agreements because they are less coverage, competitive sectors are excluded, and there are a lot of sensitive lists. That's all I have to say in this presentation. Thank you very much.
Thank you, Dr. Asanka. In the first and second presentations, we focused on the macroeconomic outlook of the Sri Lankan economy and the changes in the global trade flows and their impact on the Sri Lankan economy. Based on these points discussed in the two presentations, now we are moving to the commentary by Dr. Missaka Warusawitharana from the Johns Hopkins University of the United States. Over to you, Dr. Missaka.
Thank you, everybody, for the invitation to this exciting launch of the report. I do want to sort of stress that the comments here reflect my own personal views and do not reflect those of my employers, including the Federal Reserve Board or its staff. We've sort of seen some excellent presentations by Dr. Weerakoon and Dr. Wijesinghe. And for my own discussion, I want to try to step back a little bit and think about things from a longer perspective. And thinking about the evolution of Sri Lanka's economy from a longer term perspective, one unfortunately finds a situation where the growth trajectory of the country has been a little bit slower than ideal. Following the end of the war in the early parts of the 2010s, we saw a spike in growth. That has now sort of tapered off, and economic growth in Sri Lanka has, to some extent, lagged behind that of our peers and neighbors. This is unfortunate, as it means that the overall well-being of people in the country is not rising as fast as it could be doing. One of the drivers of this slower economic growth has been a productivity growth that has not quite kept up to potential. The manufacturing sector in Sri Lanka, although it's contributing to our growth, is not demonstrating sufficient sort of productivity growth that would enable us to reach a higher growth trajectory. This is not an easy problem to solve at all, because there's lots of different drivers to these things, including sort of trade restrictions. At the same time, trying to think about ways in which we can encourage our private sector to become more productive, and including sort of ways of reducing some hindrances that may be applying to the operation of private businesses could enable us to reach a higher, longer-term growth trajectory. The slow growth trajectory also intertwines with one of our ongoing challenges, which is the fiscal situation in the country. The fiscal situation, which, as everybody has acknowledged, is strained, has been driven in part by structural imbalances in our budgets that have spanned decades. And these imbalances have been there under sort of multiple administrations, and they essentially reflect a little bit of a willingness to spend and a willingness to make an unwillingness to make hard choices. It's kind of left us in a slightly difficult situation, and I think in the near term there needs to be a lot of attention, and I think there is rightly a lot of attention in trying to get us through the current fiscal strains. In the longer term, though, it is important to think about how to structure the country's balance budget in a way that sort of enables us to slowly draw down the debt of the country to a more manageable level. The slower growth rate that I've sort of mentioned earlier ties into this, because if you do have faster growth, then you are actually able to facilitate and finance a higher rate of borrowing. So the two problems are to some degree intertwined, as the high debt growth interacted with the low productivity growth in the country has led to a situation where there are sort of no real difficult fiscal choices to be made. The last point I wanted to kind of discuss, and I think this has been raised in one of the comments too, is to think about sort of the longer term growth trajectory of the country and what we can do about it. So one of the big advantages Sri Lanka has is that we score well on the Human Development Index, and we also have a very well-developed and knowledgeable workforce. So as the whole world economy moves away from physical goods and move towards more of a digital-based economy with services and software, for instance, playing a broader role in global economic activity, there is really a lot of room for us to leverage our knowledge base and enhance our contributions to the global service sector. We've seen our neighboring countries do this quite effectively. So for example, over the past decade, India has seen a rise in many private sector companies that have managed to become an integrated part of the global service economy. While there's been sort of some examples and some sort of strong developments in Sri Lanka, these have unfortunately tended to be the exception that proves the rule rather than a steady and widespread growth rate. So to the extent possible, I think we have been underinvesting a little bit in service producing sectors, and we have the ability and the knowledge base to really do more in that regard, and trying to sort of move us towards an economy where companies are able to engage more actively and be more competitive in the provision of global services. We can potentially be sort of one way out of this current strained situation. And it can also potentially help us lead to a longer term growth trajectory that I think will get us closer to where everybody wants us to be. again, I think it is important to recognize that there are many kind of institutional barriers in Sri Lanka towards this thing, and the more we can do as a country to try and improve our business environment, I think the better off we will be, and the more easily we will facilitate sort of private sector growth, both in the service industry as well as in the manufacturing sector. So overall, we are kind of going through a slightly difficult situation right now, and some of our, and that is reflecting the past performance over the past decade or so. And in the near term, we do need to kind of figure out a strategy for kind of emerging from the current difficulties and kind of getting to a post-pandemic world where the country situation is fairly balanced. And then I think it would be helpful to think about turning towards the service sector and the knowledge-based economy as an area for future growth and development. And I think this is an area where there's real potential for the country to shine and to really help lift the living standards of people in the country. Thank you.
All right, with that note, now we can directly move to the Q&A session. I would like to remind you again that you can send your questions via the Q&A box. Dr. Dushni, let me move to you on our first question. In the initial presentation, you explained the macroeconomic outlook of the Sri Lankan economy. However, the Sri Lankan economic recovery is not determined only by the domestic factors. It is vulnerable to external shocks as well. Therefore, what are the global developments that can pose a threat to Sri Lanka's economic recovery?
Thanks, Tharindu. I see two things that should be at the top of the policy agenda to handle. First is that when you look at the US, for instance, I mean, there is a pickup in inflationary pressures in those countries. It's considered to be more of a transitory phenomenon right now, and not that inflation has taken root, but I'm sure that they will be watchful, and if it does require any tightening of monetary policy in the US, then that has direct implications for Sri Lanka. It will have an impact on our exchange rate. It will also have an impact on the cost at which we will be able to borrow from international capital markets. Second is the rise in oil prices. I think we've now hit a 3-year high. It's $80 a barrel. And given our straitened circumstances with regards to the amount of forex that we have, higher expenditures on the import side is going to be a very tricky problem. And it's not only petroleum, it is also gas. So the external side, the recovery broadly in our major export markets, that's good news, but the risks are threatening to overshadow that, I would say.
Dr. Asanka, let me come to you next. In the presentation, you highlighted that Sri Lanka needs to restructure the existing trade agreements. So what is the current status of the regional trade agreements, and how do you examine the way forward for Sri Lanka?
Thanks, Tharindu. Currently, we have actually a lot of trade agreements in the region. We have SAFTA, and we have free trade agreements bilaterally with countries like India and Pakistan. We are negotiating with some other countries to have more. The issue is that these things were actually discussed in detail in previous literature too, like these sensitive lists countries are keeping. That means they are not going to liberalize that products import to the countries. So tariffs will be there for those countries, those products. The other thing is rule of origin And these sensitive lists are sometimes strategic. They intentionally omit the sectors we have a comparative advantage. We did a gravity analysis using the latest gravity techniques available in the literature, and using multi-input output regional data table, we disaggregate gross exports into parts of the GVC value chain. We found that actually there is a trivial effect of RTS in the region, in the regional trade. So I think one thing is, when we negotiate new trade agreements with the regional countries, we need to focus on this aspect. The other thing is that when we negotiate on the trade agreements we are currently having, we need to focus on this rule of origin and the sensitive lists we have under these agreements. I think if we fully liberalized, we will see some gains. It is not always possible, because there is this politicians' objective function here, that the producers are going to be affected. So our take is at least look at these intermediate products and try to increase the industry trade in the region. It will be beneficial for us even to increase the utilization ratio, like in textiles to GS to the EU. Yeah, that's my answer to your question.
Okay, Dr. Missaka, let me bring you here in discussion. As we already discussed, there are several challenges to Sri Lanka's economic growth. However, the growth of business in any economy provides support to overcome these challenges. So what role does a business-friendly environment play in fostering growth, especially for Sri Lanka? Over to you, Dr. Missaka.
Yeah, so I think a business-friendly environment is in many ways quite critical towards fostering economic growth. There's been sort of a well-established literature in the trade and economic growth that sort of demonstrates both sort of strong institutions that support and facilitate growth of private businesses, as well as strong capital formation has been two key drivers of aggregate economic growth. I think the earlier presentations have shown that capital formation, for example, in Sri Lanka has lagged, and I think private firms need to have confidence that their investments will be respected and valued for them to have to wish to sort of invest significant amounts of funds in various activities. And I think for the same applies for the service economy too. The service economy is very mobile and can locate itself in many different places, which should be an advantage that Sri Lanka can exploit. At the same time, if there are hindrances towards the growth and formation of businesses, then that's going to hold us back. I think one of the questions that I've sort of seen also talked about how we can better facilitate the integration of Sri Lanka into the global service sector. And here I think we can kind of make that a little bit more formally a part of our export agenda. Try to sort of use trade shows, try to use foreign delegations to try and showcase and highlight the hopefully growing service sector in the country and its ability to thrive and export its services. Here too, I think the private sector has a key role to play, because one of the most difficult things to do in any kind of an export business is to find customers, and that in some sense has to be the primary responsibility of the individual firms themselves, and there's only a certain amount that the government can actually do to help that. Thank you.
Dr. Dushni, there is a lot of debate and discussion in recent times on Sri Lanka's debt sustainability. Could you please explain, would this involve a debt restructuring?
Yes, Tharindu, now, we've had a lot of webinars and panel discussions on whether a debt restructuring is on the cards. Now, I think that given Sri Lanka's, debt matrix today, a debt restructuring is not an easy step to take. It's highly complicated once you have entered into global capital markets and you have issued bonds. The process becomes a very complex one. You have to deal with your bilateral lenders, you have to deal with your multilateral lenders, and you have to bring the foreign investors, your hedge fund investors, pension fund investors, etc., who have bought the sovereign bonds into those discussions. So there is no debt restructuring process framework for middle-income countries. There is one for low-income countries, the G20 framework. Now, for a middle-income country like Sri Lanka, to get started on this process would involve that we bring on board the IMF, because it is the IMF that will give some degree of confidence to, particularly to private investors, that there is a plan and that debt will be brought down to such and such a level by such and such a date, and we will be able to then meet our obligations. So it requires that we have an agreement with the IMF in the first place. But there is also something called a collective agreement in our clauses in our sovereign bonds, which requires that the majority of big investors are able to proceed with the discussions, and a small minority of investors can't derail that process. But the risks are quite huge. As soon as you enter into any debt restructuring, risks about your reputational risks are there. You can maybe see a higher sort of cost of debt issuance in the future. There may be litigation. Countries that have gone through this process have faced these problems. So to me, it's very unlikely that Sri Lanka will go into that debt restructuring on our foreign debt, because the process is perhaps, the costs are perhaps greater than the benefits in the near term.
Okay, I will forward our next question to Dr. Asanka. Dr. Asanka, we have been experiencing some increased quantitative restrictions for imports. So these import restrictions intend to promote import substitution. It is what it seems like that. However, you emphasize that domestic substitution is costly. So why is that domestic substitution is costly for Sri Lanka?
Yes, actually, we are seeing about 31% of our imports in 2017 values are under some kind of import controls right now. They have in different forms. Some are banned, some are under import control license, some are temporarily suspended, and some have this credit basis requirement, 90 days or 180 days, like that. Some of them are actually intermediate goods. That is not a good thing, because some of these intermediate goods are used to produce exportable products sometimes. And to answer your question that why domestic substitution is costly, this is a small country. We have less factor endowment. Like we don't have huge stockpiles of raw materials. So we will have to import machinery and these intermediate raw materials in our attempt of domestic substitution. Even central bank data recently show that our trade deficit is widening. The major contributing factors are fuel, machinery, and textile articles, because we use them for our textile exports, base metals, chemical products. So the ultimate outcome is that there will be higher growth of dollar outflows than the growth of dollar inflows. Then our forex crisis will continue. I think the government's motivation is, for some products, yes, it is domestic substitution, but some certain measures are because government wants to handle this forex crisis. But the recent roadmap by the central bank governor, it seems that this domestic substitution is kind of a long-term strategy. So strategies outlined in these 6 months, 1 year, and medium run strategies. He mentioned encourage import alternatives. Actually, this is, I think, something like the domestic substitution. So that will be a costly thing for the country. It will pull out resources from the comparatively advantaged sectors, and it can affect our exports growth. That's why I'm saying it is very costly for the country, especially for a country like us, which is small and with less factor endowment.
Thank you, Dr. Asanka. Dr. Missaka, much empirical and theoretical work emphasizes that research and development is an important contributor to economic growth. However, Sri Lanka's engagement for the allocation for research and development is really limited. In this context, should Sri Lanka focus on innovation or importing ideas from abroad? Over to you, Dr. Missaka.
Yeah, so thank you, Tharindu. I think that kind of given where we are right now, kind of spending resources on, trying to generate a lot of new innovation may not be the most value-added activity we can do. I think we may be in a better able to benefit and leverage from kind of importing ideas from abroad and implementing them. I think there have been some studies that have shown that for countries in different stages of their growth trajectory, such importation of foreign ideas and implementation of them can be the best way to go. I also want to sort of tackle, I think, another question that's been posed about whether a transition to a knowledge economy is easy to do given Sri Lanka's existing workforce. My understanding is that the country suffers from a chronic underemployment problem, and I think we do have a fairly significantly educated workforce. So to the extent that we make a push towards increasing contribution to the global knowledge economy, I think we are able to do that. And another factor I think that points in this direction is that there's a lot of demand in the country for education. And so to the extent that we have that people in the country see that there is sort of more returns to be had from investing in the knowledge-based economy, I think it's kind of natural to expect that there are, in some sense, the emerging workforce will also move in this direction. So I don't see the workforce as being a strong hindrance. And in fact, I see it as being something, as an asset that we can effectively deploy and strengthen our role in the knowledge economy. Thank you.
Dr. Missaka, I would like to forward some follow-up question as well. When focusing attention to the productivity of the Sri Lankan labor force, there are some kind of significant issues. The majority of the labor force is working in the informal sector, and therefore Sri Lanka needs more professionals and skilled workers as well. And we need tertiary level education reforms as well. So based on these circumstances, what about the role of the private sector in Sri Lankan education?
Yeah, I think the private sector plays a positive role in facilitating education in Sri Lanka, both at the secondary level and especially, I think, at the tertiary level. what the private sector can do is it can help increase of availability on like professional education, as well as sort of help develop sort of skills that are useful for various trades. And I think kind of just encouraging private sector facilitation will help reduce costs to the emerging workforce, and then help us, and I think support overall growth both in the manufacturing sector as well as in the trade, as in the service sector. Sorry.
Dr. Dushni, as you have already pointed out, foreign debt and macroeconomic instabilities are challenges to Sri Lanka's economic growth. In this context, what is the outlook for foreign direct investment, and how can such inflows support Sri Lanka's economic recovery?
Well, if you have policy environment that imposes certain restrictions on foreign exchange, on capital outflows, and also on imported inputs, then there will be questions of will foreign investors come in, because it is a highly competitive global economy out there. Now, what we might see under those circumstances is investors who will come into less productive sectors, mixed development projects, real estate transactions, etc., which will, a construction sector. These will provide an initial boost to growth, but the sustainability of that growth process is, again, there will be some question marks. We've gone through this cycle earlier in the immediate post-war years, when there was an increase of foreign direct investment, but into sectors that boosted construction and other forms of investments in apartments, hotel complexes, etc. But they don't generate productivity gains in the economy, and they don't generate the kinds of employment that our labor market needs. So we have to look for what we might call efficiency-seeking FDI coming into the manufacturing sector, coming into the high-end service sectors. But attracting that kind of FDI is far more difficult. We have to provide a stable macroeconomic environment and a fairly attractive policy, regulatory and policy environment for that kind of FDI. So the answer is yes, we might get some FDI, but is that the kind of FDI that will help us to sustain the post-pandemic recovery over the medium term?
Dr. Asanka, my next question goes to you. Sri Lanka's preferential access to the widely European market faced challenges, especially after the European Parliament's special resolution, which was adopted in June 2021. So how would you assess the impact of these changes, and what is the way forward for Sri Lanka regarding the GSP+?
Tharindu, as I said in the presentation, actually we use this partial equilibrium impact that assess the sectoral effect. As an example, what will happen to the textile exports? Like that, we estimated that the cost may be about 627 million US dollars. So our global export market is about 12 billion. So it's a substantial amount of money. Another impact is how these sectoral effects will spill over to the overall economy. One objective of this GSP Plus is actually alleviation of poverty and increase in household welfare. So there will be household level impact. We can use these general equilibrium models to estimate the effect. It was done actually when in 2011 when we lost it. There is this article published in the World Economy journal. They found substantial effect on households. So we have these effects. Way forward, one thing is it will be politically and economically beneficial if we secure GSP plus preferential access, because our competitors have this. Bangladesh has EBA, everything but arms. Pakistan is enjoying that. So we will be in a bad position if we lose this. That is not the end of this way forward. I think we need to increase the utilization ratio. We do not utilize the total eligible exports to the EU under GSP plus. It is about right now 62%. One thing is to identify the sectors with the biggest preferential margin. That means the difference between GSP plus tariff and the MFN, most favored nation tariff, and encourage investments to those sectors. We identify sectors like, of course, apparel and tobacco products, fish and crustaceans, and edible vegetables, preparation of vegetables. This sector, preparation of vegetables and fruits, actually the difference is about 30%. It is huge. And we are seeing this government's green drive, that means this organic agriculture, that if we are having any kind of hope to export our organic products, EU will be the market. So we can encourage those investments. I saw that Germany, they extend support to increase organic production in Sri Lanka. I think that will be the way forward.
Thanks, Dr. Asanka. Dr. Missaka, I simply forward my last question to you. How to facilitate integration into the global service economy?
Tharindu, and I think I already addressed that
Okay.
question earlier, so I don't really have a lot more to add to that.
Okay, Dr. Missaka. Then, Dr. Dushni, does the Sri Lankan government have any realistic alternative to seeking an IMF intervention?
Well, it all depends on what we ourselves propose to do. I think the issue is that, you know, we have gone through 16 IMF programs, and I think Sri Lankan policymakers are well aware of what needs to be done, and we don't really need the policy prescriptions to be spelled out to us. The IMF also doesn't bring much money as such in with the programs compared to what we need. It is simply that an agreement with the IMF suggests that there is some discipline that you will, you know, implement the programs and see them through. And it will help to firm up sovereign ratings and ease access into capital markets. Now, the downside is, as I mentioned, ongoing negotiations, you can see there are very stringent conditions that are attached to IMF programs, and the government will weigh up the costs and benefits. Is it worth going in and having these harsh conditions, or will they be in a position to put forward some fiscal consolidation path and build on that to access international capital markets, attract foreign direct investment, and slowly ensure that there is more stability on the external front. My sense is that that's what they will try to do, and the budget preparation is perhaps the first step to that. But that's not to say that the door is closed on the IMF. I'm sure that, you know, there's always a crack open there in case you do need to approach them.
Thanks, Dr. Dushni. On that note, I would like to thank all three of you for taking part in this webinar. Dr. Dushni Weerakoon, Dr. Asanka Wijesinghe, Dr. Missaka Warusawitharana, thank you so much for your valuable contribution to this webinar. Before we conclude, I would like to remind you that this webinar is the first of 3 that ITS has organized on the State of the Economy 2021 report. The second webinar will be held on October 13, and the third on October 14th. We would like to invite all of you to attend those webinars as well. And you can visit our website, www.ips.lk, for further details. And thank you very much to our audience who have joined us. I tried integrating all your questions. So thank you very much and have a nice week.